Hello, everyone. Can you hear me? All right. Yeah. Yeah. So normally you guys should hear me now. All right. So during this webinar, we're going to talk in English. Okay. So if you have any questions or you have any comments, write it in English. So also Mr. X can read it. And at the end, we're going to do a Q&A for you guys. Where we're going to answer all your questions. Okay. So today is going to be a very interesting presentation. And thank you all for being here. We have a nice little crowd going on, so that's great. I'm going to start sharing my screen and pop up the presentation that we prepared for you guys, okay? Um, so I'm going to share my screen here. Normally, this should be visible right now for you. All right. So today we're going to talk about Meet My Trading Mentor. So welcome, everyone. Today it's a very special day because I convinced my mentor to come and speak for our little investment community here. 3 years ago, I decided that I wanted to get mentored as a trader in the stock market. As you all know, I have a past with investing, but I didn't have any experience trading the markets. So I went to work and I went looking for the best teachers and mentors on the planet. And it took a lot of work to find finally a man, a trustworthy man, a man that is very good at his job. And I'm going to introduce you today to him. He's by far, in my opinion, the best teacher, mentor, and experienced trader out there for normal people like us to learn from. And since we are an educational platform around investing, I think you all should meet him too and see what he has to offer. So he has mentored me for the last 2 years, and I've achieved a lot of success because of it. As you know, I wrote a book, and that's mainly because of all the things I learned from my mentor, Mr. X. Today, I hope to show you the pathway to the success that I've had and to inspire you to do the same. He will give a very interesting presentation, so I hope you all are going to enjoy it. So it will be extremely educational and helpful for your future in the financial markets. And being a good trader also makes you a better investor, and we're going to talk about all of that. Okay, so let's get started. Okay, so a little bit about me. I have to go through this because this might go on YouTube, and the people on YouTube don't really know me. I know you guys already have seen this 1,000 times. But so I started investing in 2009 together with my father, and I started reading a lot of books basically to get started. Then I wrote my first Seeking Alpha article in 2013, and that first article was an immediate success with the stock being taken over and the price doubling basically. Then I was the founder of Beursadvies. Many of you guys followed me from that platform to this day, so thank you for that. Then that website got taken over, and I was a manager of a value investing platform that you all know, I think. And I was also an independent analyst for multiple stock newsletters behind the scenes. Then I was working as well during COVID as a professor at Artevelde Ghent because a professor got really, really sick and I replaced him. And then I taught the course, I gave the course Introduction to Financial Markets to the students. Then I launched Beleggers University, right, together with our co-founder. And we focused on education because we saw that many retail investors need help with education. And we also try to give them good stock research. And that's for the Dutch and the Belgian market. Then in September of 2022, I decided to do something life-changing. I sold my car and I did some mentoring with the best guy, the best trader in my opinion, an ex-trader from Goldman Sachs. He's here on the webinar today. And then in October of 2024, I published my book, The Lost Art of Shorting, only available right now in the Netherlands and Belgium. So in short, my experience is 15 years in the markets, 10 hours per day researching stocks and giving fundamental stock picks, right, with a high win percentage. And I've appeared in multiple media in Belgium. All right. Good. So today we will discuss why I chose to be mentored by a professional trader, what was my pathway, what results did I get by being mentored by him. So mentorship is really important, right? It can really change your life, and I'll show you what it did for me. Then the big reveal, who is my trading mentor? I know some of you might already have figured it out, but I think most of you didn't. What is his origin story and how did he ascend to the top of the industry? It's a very interesting story, very inspirational. So if you're looking for inspiration, you're going to find it here. Then you're going to get some insights into his students' results, because I was just one of his students, but he continued to teach regular people how to trade, and the results that he gets with them is really, really insane. Then he's going to also look at what makes a good trader and a bad trader. I think we can all learn from that. And we're also going to look at the crossover skill sets of trading to investing. So when you become a better trader, you also become a better investor. And we're going to see how that all fits together. And now we're going to do Q&A. So why did I choose to be mentored by a professional trader? Well, as you know, it might sound weird, right? Okay, you're already a financial analyst, but why do you then go follow mentoring if you're already doing it as a job? Well, okay, I might have been good at picking stocks, but I was not so good at managing my portfolio. I always felt I could do way better if I knew how to go short, right? If I could use stock options, if I knew how to position myself better, how to minimize my risk, and also how to benefit from massive moves in the market. When you're just working with long only stocks, it's really difficult to outperform. So I wanted to learn how to lower my risk and get bigger returns. I wanted to sharpen my stock picking ability. You might be shocked by this, but actually it's the truth. When I was a financial analyst, it's so easy to just look at value stocks, what is cheap in the market. But these are often not the stocks that are going to give you the big returns. We also see this right now in our selection list at Beleggers University. It's often the growth stocks or the quality stocks, and not the value segment. The value segment can stay flat for a long time, and it takes a while before the market values it correctly. So I wanted to improve my stock picking ability, and I wanted to improve my conviction when entering a position. So I wanted to learn from the best guys in the business, not a fake charlatan or some guys who just read a few books. That's what we see a lot in the education space in Belgium. Some guys read 3 books and they think they're an educator. No, I wanted to learn from a guy with real experience trading with big money. Okay. So after watching his online media, when I found my mentor, basically, I immediately liked him as a person. We had the same mindset, no bullshit approach, and he was really inspirational. And then you start to realize, okay, there's levels to the game. This guy is really on another level. I might be an analyst in Belgium, that's great, but he's on a way, way different level. So I wanted to learn from him. So what was my pathway? Well, basically, I decided to go all in. I was really talking about this with my wife before I made this decision. And I said, like, okay, I really have to do this. I know it's really expensive to follow mentoring with him. It was out of my budget at that time. So I decided to sell my car. So I sold my BMW X4 for 50,000 euro. And I basically invested a big part of that into my mentoring, to do the mentoring with the guy you're going to get to know soon. I also got access to his online trading programs, which are really good and are considered to be the best in the world. We're going to talk about that as well. And on top of that, I got to meet my hero. So for me, when I followed his YouTube videos and stuff, I was already like, wow, this guy is really someone I would like to meet. So it was really cool when I could finally meet him. So I flew halfway around the world to be taught in person in a classroom setting by my mentors. And I immediately felt a good vibe that were like, okay, I really understand what he's saying, and I'm going to do great here. So I got time to network with other traders who are also learning alongside me. That was a really nice bonus. I got a dream vacation. You're in a really nice resort when you do mentoring with Mr. X for 10 days. So it was learning and relaxing at the same time. So it was really my dream vacation. And then after that, and then we just trading together, stock options in the market. Okay, so that was my mentoring experience. Really nice. Okay. And then everything just fell into place for me, and it all became clear how it all works. So I became a profitable trader here in this resort. Really nice location. So that was epic. Now, what results did I get? Later, I will show you how much money I made. But here's a hint. I recouped my investment and made a lot more. And by learning how to become a good trader, I instantly became a better investor and analyst as well. So it was really adding to my skill set. So I learned how to use stock options safely and in an optimal way to my advantage. I learned how to take advantage of stocks and indices going down. and shorting while minimizing your risk. That's also what my book is about. So I learned how to properly manage my overall risk in a diversified long-short options portfolio. And I definitely made a new friend and mentor for life. And maybe that's the most valuable part of all of it, because money is really great, but friendship and mentorship and sharing knowledge is even greater. All right. So on YouTube, there's a video, Dieter the Doubler. You can learn more about my trading journey there, but you can do it after this webinar. Don't go do it now, because then you will miss the webinar. All right. So now it's time for the big reveal. You're going to meet my trading mentor. Okay. So I'm going to just switch it off here. And I'm going to introduce my mentor. Hey.
Hey, Dieter. Hey, everybody. How are we doing? I'm going to share my screen here. I think, Dieter, you have to accept on your side, right?
Yep.
There we go.
Yep. Here we are.
Thank you. Welcome. Thanks, Dieter. Thank you guys for attending today. My name is Anton Kreil, and I mentored Dieter as part of our Thailand mentoring program in 2022. And been mentoring Dieter now for around 2 years. And I think today, what could be very interesting for you guys, because myself and Dieter had a talk about this, and what would be interesting and most apt to present to you guys today is basically like my journey, how I became a trader in the financial markets, what I've learned over the years and what I focus on and what I taught Dieter. Okay. For retail traders, it's very, very important to see all of those things, because there's just so much misinformation out there. It's very, very difficult to actually get the truth if you're a retail trader. So we're going to go through everything today in a brief way. Obviously, we've only got a couple of hours here. So we'll try and go through as much as we can in the time that we've got. Okay. So as I say, my name Anton Kreil. I studied economics at the University of Manchester in the UK. I was then hired into Goldman Sachs at the age of 20, 1 year before graduation. When I graduated, I show up in the year 2000 to Goldman Sachs in New York, and then I'm working in the London office for 4 years. And then I was headhunted to Lehman Brothers in 2004, left there in 2006. Thank God for that. And then was headhunted to JP Morgan in 2006 and spent a year there as a VP. But basically, throughout my investment banking career, I was working on the pan-European equities trading desks at all of those companies. I then left May 2007, went traveling around the world, did a TV show in the UK, filmed that over 12 weeks, and then went traveling again. It was then aired in 2009, went traveling after that as well. So basically didn't really do anything apart from the TV show for 3 years. And then I set up the Institute of Trading and Portfolio Management, which is the infrastructure I operate and manage now. Set it up in the UK originally, then took it global in 2013, emigrated to Singapore to get more tax efficient, set up family office investing and trading infrastructure in Singapore. Then 2022, after COVID, emigrated to Phuket. And we've become more and more successful over the years. And now we've incorporated in the Cayman Islands, and we're basically managing Cayman and Singapore infrastructure. And I'm managing it from Phuket, Thailand, where I am now. So what's my origin story? Well, this is one of the things about financial markets, guys. Access. Everyone can access financial markets, especially now. Back when I was a kid, it was actually very, very difficult. So I grew up in Liverpool, born in 1979, grew up in the 80s in Liverpool, very normal working class background. But back then, something that had a big impression on me was where I grew up and what was happening at the time. So I grew up during Thatcher's rule over the UK in the 1980s. And the contrast was huge compared to Liverpool. The politics of Margaret Thatcher and the Conservative Party at the time were huge compared to where I was growing up. Liverpool was very socialist. Okay. So I'm growing up in a socialist city with a lot of change going on, where the regime at the time, the politics at the time, the dominant politics at the time were not positive for the city that I was growing up in. And what I realized very, very early on in life, that there's basically two types of people. There's the haves and the have-nots, okay? And the have-nots that I grew up around with mostly had zero to very little ambition. I realized at a very young age that they complained about everything and had an entitlement and victim mentality. And that in contrast to that, the haves were ambitious, made short-term sacrifices for long-term gain, and had a very go-get-it mentality, okay? The have-nots basically took no risk and played it safe and ended up with nothing. And the haves enjoyed taking the risks and reaped the rewards. And I realized this at a very, very young age. So I worked very hard from the age of 11 for my own pocket money. And I was very, very driven to change my circumstances. Academically, I ended up going to the University of Manchester, but it was very touch and go. I literally didn't do anything academically until I was 16. So I was only really interested in football, lots of different sports, making my pocket money and getting into a lot of trouble constantly. And then all of a sudden at 16, something shot a rocket up my ass. And I decided, okay, I should probably do some work so I can get to a good university. Otherwise, I'm never, ever going to get out of this place. So I started trading UK stocks. Okay. And I was also behind in maths, like the core subjects. So I convinced my mum to get a private maths tutor so I could pass the exam 6 months later. And honestly, I really scraped into the next stage of academia with very, very minimal work. Okay. Then I actually worked really hard for 2 years to get into a decent university. So ended up at the University of Manchester doing economics. Trading wise, I started very, very young. So I opened an account when I was 16 in my mum's name. And I was an authorized trader on the account, as in a second trader called Mr. Kreil. And the broker just assumed that I must have been her husband. I was literally on the telephone, putting on a deeper voice to literally speak to the brokers and tell them what to do. So I was trading when I was 16 through an account that I'd set up through my mum's name. So 16 to 20, I turned around £3,000 at the time into over £100,000. And this is, one of the things that really got me into Goldman Sachs, was because when I went to the first meeting with traders at Goldman Sachs, when they come to the university to interview people, I literally showed up with my track record, just all of the trades I'd ever done. And I just gave it to the trader and we talked about it. That's one of the things that got me my first interview, for sure. It was probably the biggest thing that got me my first interview, because people were shocked that a guy from Liverpool has gone to Manchester University and turned £3,000 into over £100,000 while he was a student. They'd probably never seen anything like it before. So in 99, I was recruited by Goldman 1 year before graduation. And then I became a trader there literally 9 months later. And I got an unconditional offer, which is kind of unheard of. An unconditional offer means they literally give you a contract and say, you don't have to finish your degree. You can just join now if you want. But I said, I want to finish my degree and I'll see you in 9 months' time. So I go to New York for training. I end up in London. I was trained by the best guys in the industry. The two buildings you're looking at there are on Fleet Street in London. The one on the left is the original London Goldman Sachs building, Peterborough Court. I was there for the final year that office housed secondary markets trading. And then we moved next door to River Court. And that was at the end of 2000. So we migrated over to River Court. So based on Fleet Street, 21 years old, in the year 2000. Back then, it was very, very different compared to what it's like now. The trading business at investment banks used to have huge amounts of risk, okay? And there was a big appetite for it. And Goldman had the biggest appetite for risk on the street, okay? So what do we mean by risk? Well, the traders, the function back then was you would have two functions. You were a market maker where you give prices to customers and trade on risk with customers and on an agency basis. And if you've got any questions about that, we can go into the detail of how that works a bit later, if you've got questions about it. But more importantly, how you made your bonus, how you got paid the big bucks, was basically on your second account. Your second account was a proprietary trading account where the bank would give you a certain amount of money to play with. And over the year, you'd have a target and you try to exceed that target. Okay. So I traded multiple sectors when I was there: industrials and manufacturing, TMT, technology, telecoms, media, banks, insurance, transport, pharma, biotech, medtech, chemicals. When I started, first day was like $10 million. Here's the keyboard. Here's the buy button. Here's the sell button. Have a play with it. See if you can do anything special. Don't fuck it up type thing. And these two guys are going to help you out. These two guys are going to train you a little bit here, right? Then I work with two guys on the TMT book, do about 6 month training with those guys. And I start off with about $25 million on the proprietary trading book. And then over a 4-year period, my risk went from 25 million up to 400 million. And when I'm managing a 400 million risk, it was with 3 other guys. So there was 4 of us on the desk. Okay. So we're managing 400 million in TMT. So 2004, I was headhunted to Lehman Brothers and then to JP Morgan. And at those 2 firms, I was basically managing over 100 million up to 200, but minimum 100 to trade pharma, biotech, and chemical stocks. And I managed to leave the industry with quite a bit of money for my age before the global financial crisis. And I basically did nothing for 3 years except travel the world, party, and make a TV show. And obviously ended up setting up ITBM, the institute, which I'm running now. But back then, taking a break, sometimes in life when you take a career break, you've got to take one step back to take several steps forward, which I did. It was a well-deserved break. So when I went back to the UK after traveling, I made a TV show called $1 Million Traders, which was aired in January 2009. And what's funny is when I got the call to make that TV show, I was actually in Brazil and flew back to the UK a few weeks later, did some screen tests. The BBC loved it. And then we just started filming within 2 weeks. And I did like 12 weeks of filming, and then I went traveling again. I really had absolutely no intention of ever setting up a school and teaching retail traders. I literally did it as a project, as a legacy situation, because we were capturing, at the time, the financial crisis on television, because we filmed it over the summer of 2008. And I didn't have any intention of going back into investment banking or going to a hedge fund. I didn't want to work for anybody. I wanted to be the master of my own destiny, trade markets in the way that I wanted to do it with my own money. Okay. But the TV show was great. It was a great learning experience. We killed the ratings. 1.6 million people watched the first couple of episodes. And then episode 3, we got killer ratings at 2 million. And the show sold to a lot of countries around the world, over 20. And the BBC really considered it a very strong show, but it has a major flaw in terms of the content, right? Because at the end of the day, a trading show is just a bunch of guys sitting behind computer screens. If we didn't have the financial crisis, people probably wouldn't have tuned in as much as they did, because at the time there was a lot of fever around the financial crisis because the market was getting killed, right? So, like I said, I went traveling again. And I did notice after a year, because I set up a website, a personal website, just myname.com, antonkreil.com. I'd gotten about 25,000 messages from around the world. And the vast majority of them were asking me, Okay, I've seen you on the TV. Can you help me? Can you teach me how to trade properly? And I thought to myself, I just made a mental note of it. If I do go back to the UK, then maybe this is a problem that I might try to solve. And it became really obvious that this problem was a lot wider spread than I first thought. Okay, so here is the problem, guys. And I'm sure you've experienced this in financial markets yourself as retail traders. 90% of retail traders lose 90% of their deposited margin within 90 days. I was shocked when I saw this and started seeing all the broker statistics. And I had contacts in the financial industry, obviously. And I went into brokers' offices to see these numbers. They showed me the numbers. It's staggeringly bad. Okay. After a year, 90%, 97% of retail traders will lose everything. And after 2 years, 99% are wiped out. So there's a tiny minority that manage to stay alive. They're not managing to actually do very well. They're managing to stay alive. Okay. A very important distinction here. We're not talking about investors or pensions. Okay. So investors, like Dieter was talking about earlier, someone who buys value stocks and then holds them, but you literally pay cash for a stock. You're a shareholder and you hold it for 5 years. Okay. That's not what we're talking about here. And we're not talking about pensions either, where you pay some money into your pension every month and you buy an index ETF and just leave it forever, right? This is about after-tax dollars going into a trading account, and then you're actively trading the money on a regular basis, okay? 90% are gone within 90 days. 97% are gone within a year. 99% in 2 years. So the numbers are obviously staggering. So there's a real problem here. So I went about trying to figure out what the hell is going on and can you actually solve the problem? Okay. So here's the reasons why. The main reasons why that I found people lose money consistently. Short-term trading, day trading, essentially taking a gambling approach to the markets, generating ideas, heavily influenced by technical analysis and price action. So reading the tea leaves on a chart, looking at a chart, which is a representation of historical price, and then interpolating that to mean something meaningful that's going to happen in the future. Okay. Misaligned broker incentives. Brokers get paid a commission. They get paid a spread. If they don't get paid a commission, they definitely get paid a spread. They obviously get paid. They have to make money in some way. It's a volume-based game. So of course, they're going to perpetuate volume-based strategies like day trading, gambling, technical analysis, and price action, because they want people to be active as possible to pay more. Okay. This is a conflict of interest that is inherent in the industry, always has been and still is. Okay. But a big one is charlatan trading educators. So Dieter alluded to this earlier. Charlatan trading educators, what do we mean by that? It's guys basically impersonating professional traders, passing themselves off as experts. So a guy off the street reads 3 books. He orders 3 books on Amazon for $20 each on technical analysis and day trading, rips a load of the content out, puts it in a PowerPoint and does a webinar. And then people start believing that the guy's a genius, right? Okay, compare that guy to someone who's worked in the industry for 25 years at investment banks and hedge funds, who's worth 100 million or a decamillionaire, right? Of course, there's a massive difference. There's a massive difference, okay? The problem is retail traders don't understand the difference. So they end up going with the people who are entertaining rather than the guys who are actually good, okay? So what is the solution to all this? Well, what I talked about earlier, the proprietary trading books at investment banks, we take the same approach, but we do it in a retail trading account, right? So obviously the numbers are smaller, but all of the principles and the approach is exactly the same, okay? So the way we did it all the time in what we'd call our back book, our proprietary trading book, is exactly the same way as all hedge funds do it, okay? It's the same way that our hedge fund clients would have done it. And this is why you see a lot of guys who were pre-2010 investment bank traders move from investment banks to hedge funds. Okay. Why? Because after the global financial crisis, the regulators in the US brought in a new rule called the Volcker rule, which came into effect in 2014, but all the investment banks prepared themselves for it from 2010, where they basically stopped trading proprietary accounts, which means all the good traders left the industry, and they either left completely or they went to hedge funds. But the investment bank traders pre-2010 are like the hedge fund traders of today. We traded in exactly the same way on our proprietary trading accounts, which is as follows. We take a 1 to 3 month time horizon, so 20 to 60 trading days. And if you're in the stock market, that will involve stock options, and you'll be trading call options and put options and building portfolios. And you'll essentially be managing a long, short portfolio. Okay. We are 90% fundamental. So anyone who tells you that professional traders are 80, 90% technical analysis and price action is an absolute bullshitter. There are no professional traders at investment banks and hedge funds that have 90% of what they do in a decision to buy or sell an asset rooted in technical analysis and price action. It's in the minority. So we're not saying it's completely useless. It does have its uses. Its use is for timing, right? But fundamental analysis is the most important thing. And this is where the crossover comes in with investing. So Dieter will go into more detail about this later in how if you become a good trader, you automatically become a better investor. Why? Because you become a lot sharper on the fundamentals and what drives stock prices. Okay. So the main point here at the moment is if you're going to take a professional approach, the real professional approach is 90% fundamental with catalysts and 10% technical analysis and price action. If anyone tells you it's the opposite, that's the big red flag. As soon as you see that, you know that guy's never been a professional trader. Okay. As an organization, what we did very early on, we eliminated the misaligned broker incentives. How did we do that? Well, we went to the brokers and said, look, we just don't want to be paid. So I don't know if you know how this works, but even today, educators, especially the charlatan trading educators, they have contracts with brokers where they get paid offshore, a percentage of the commission that you pay the broker. Okay. So what are they going to do? Of course, they're going to teach you how to trade every day. Of course, they're going to teach you how to trade as much as possible in the biggest size possible. Why? Because that's how they get paid. Okay. We eliminated that as soon as possible. So we just said to the broker, we don't want to get paid. Whatever you write on that contract, okay, to another guy, let's say it's 20%. We want you to write on the contract 0. So the contract doesn't have to change. It can all be the same legal application, but 0. Just put the number 0 on it instead of 20, 30%. So they did. And it's worked brilliantly because now we provide, rather than hundreds or thousands of traders that blow up and then they have to be replaced all the time, we provide the brokers, if you think about it from their perspective, we provide the brokers thousands of traders that never blow up. They just stay on the platform and trade, but they just trade less often, but they live forever. Okay. So the brokers love us. The next solution, and it has to be very, very disciplined and detailed and principled here, right? Retail traders must get only educated by ex-investment bank traders and hedge fund managers. Now, why do I say ex? Well, if you're in the industry, you can't teach retail. As in, if you are literally working at an investment bank or a hedge fund right now, you can't speak to retail. You're not allowed to. It's against regulation. Okay. So you have to have left the investment bank or the hedge fund. And on the investment banking side, the key is being taught by someone who's pre-2010 investment bank, because everyone who came afterwards didn't actually trade proprietary risk. The guys that you see at investment banks now are not trading proprietary risk. They are trading agency business. They take very little risk. The risk that they take is what we would call negative selection, whereby if a client comes in and they are forced to trade with the client. So if a client wants to buy, you have to short it to them. And then you can have a decision where you can run the position or you can trade out of it. If you run the position, it becomes a view. It becomes a proprietary position, right? But you can't choose to do it. That's the difference, okay? So very, very key for retail. Time horizon, 1 to 3 months. 90% fundamentals, 10% technical analysis and price action. Eliminate the misaligned broker incentives and get educated by the people who actually know how to trade, okay? And that's what we've built at ITPM. And this is the reason why we've been very, very successful, is because every year that goes by, all these charlatans, they come and go. They come and go. They have their moment in the sun. They disappear. Another guy comes along. We're always here. Why? Because we actually solve the problem. And our brokers love us. And I wear it as a badge of honor. Our other educators hate us. Why? Why do they hate us? Because they can't be us. It's literally impossible for them to be us. There's a lot of professional jealousy and envy surrounding ITPM and the educational community. So something we do, and Dieter obviously showed you some pictures of him in the classroom a couple of years ago. We do this Thailand program. So I'm just going to give you a little peek at the results of this year. This year, this is 18 guys that were taught over 14 weeks. They came to Thailand in the last week of April. And they were taught every week over the Zoom from the first week of May till the middle of August. Okay. So week 14, this is their results at the end of the mentoring program. So they basically traded 4 monthly options expiries in the US. Okay. So you can see the totals at the bottom. For example, we started off as a group with $1,578,000. Okay. And you can see each guy individually has 100, 40, 50, 75. You know, the biggest guy has $300,000 in his trading account. We start off $1,578,000. 14 weeks later, the group is at 553. So we make a group return of 35%. Okay. Out of all of the guys, 2 were either flat, small down, or down. I mean, we're trading options. And I mean, this guy, Zach in Singapore, negative $375. It's so completely irrelevant. Okay. This guy, Nitty, down $1,400. It's so irrelevant. We're trading options. That can be made back in less than a week, easily, right? What's happening here? And I'm sure you'll have many questions as to, you know, what makes someone succeed on the programs, what makes someone not fail or not succeed. This is basically a failure to launch. It's like when a kid leaves home and they don't know how to wash their own clothes, iron their own clothes, cook a meal or whatever, right? What we've taught them in the classroom and what they've been taught over the 14-week period, it's just not sinking in. They haven't got it yet. It's a failure to launch. So what's happening here is the mentor at ITPM is making sure that they don't lose money. The mentor is protecting them to make sure that they don't lose money, right? And I would say that's the case with these guys as well. So Wang Seng and Alessandro, because they should be making a lot more money than that over the 14-week period, right? The rest of the guys, it's probably worked to an extent for these guys where they're starting to get it and it's starting to sink in. But at least half of these guys in the group have definitely got it after 14 weeks, okay? If we look at the returns versus the market over the time, okay? So what we really care about as traders is how much dollars we make. We want absolute return, but we respect risk-adjusted return, okay? And we like to make money when the market goes up and down. Okay. So Dieter alluded to this earlier when he's talking about only being long only. Traders are expected to make money regardless of the direction that the market goes in. If the market goes up, we make money. If the market goes down, we make money. That's our job. Okay. So if we look at the market here, May 3rd till August 16th. So bottom left corner, over that period, S&P was up 8, NASDAQ up 9, Russell 2000 up 5. And then we look at all of these guys here, what they're performing versus the market, and also in absolute. And then on the right-hand side here, you can see what their win-loss rates are. So if you want to see something absolutely insane, the guy, Adam, who started with 300,000, got a win rate during his program of 83% of the trades that he completed over the 14 weeks, okay, which is absolutely ridiculous. It's the highest that I've ever had as a mentor teaching someone. And then the rest of the guys, if we look at a group average, and bear in mind, this also includes the guys who were struggling at the bottom. This is a group average. So it's 63 versus 37, which is amazing. And then we have something here called the R score. The R score is basically, R stands for ratio. And it's the ratio between the dollars that you book on your winners divided by the dollars that you book on your losers. Okay. So the top guy here, Porrick, he started with 100,000. He made 68 grand, 68% return, outperformed the markets by 60%, 68% win rate, 32% loss rate, R score 282. So what does that mean, the 282? It means he's made 2.8 times the amount of dollars on his winners than he lost on his losers during that time. So this is the beauty of trading, right? It's a complete acceptance that we have losers in our portfolio. These 32% of losers here, on the 68%, he's making 2.8 times more than the 32% of losers. Okay. Now what we're going to do is, and this is the reason why I've highlighted these two guys, we're going to look at Porrick, his trades and his track record, the top guy. And we're going to look at Adam as well, the guy who started with the most money and got the highest win rate. Okay. It's just going to be interesting for you to see what happens when guys actually succeed. Why? Because if you can see what it looks like, you can look at the pathway and potentially walk the pathway to get there, right? So you know what you're working towards. Okay. So if you want an insight overall into ITPM student results, we've got quite a lot of videos online. The YouTube channel, Institute of Trading, Dieter will have watched YouTube videos on that channel before he even decided to come to ITPM. And a couple of years later, guess what he's doing? He's making a video with me talking about his 100% return in 6 months on our program. So Dieter made 123 grand on his program in 6 months. You can see that video if you just type into YouTube, Dieter the Doubler, meet Dieter the Doubler. Okay. So we obviously have a lot more students than this at ITPM. We've got 1,500 traders. We've got thousands and thousands of alumni around the world from the last 10 years. We've interviewed a number of them, guys who have done mentoring programs. The guys who we've done mentoring programs with, they're good examples to look at because you can see what needs to be, achieved at the end of a program, and then also what you need to do when you leave a program. Okay. So when you see that, it's important, right? Because very rarely retail traders get to see the end result of what professional traders actually do, right? And then obviously there's a pathway to walk to get there. Okay. So the guys that we've got on YouTube, you're going to see those videos, and in total they've made $1.2 million. Okay. But we've made a lot more than that over the years for our students. So what are we trying to do here? with each student. A student that comes in cold, a student that comes in with no experience at all as a trader. After a year, we want you to get these statistics, okay? So these are the professional level stats that determine when you can turn around and say, after a year, I'm actually pretty good at this. I'm going to continue doing it, okay? It's the first hurdle. So 125 to 175 trades in a year, that's going to give you what we would call statistical significance. You're going to target an absolute return of 50 to 100%, but there is no upper limit. We're trading options. You can make a lot more than 100% if you get some really outstanding trades during the year, okay? But if you do this right and you're diligent, you will land most of the time between 50 and 100%, okay? Win-loss rate, you've seen it with the guys on our Thailand program, 60-40, typical, but you're targeting 65-35 all the time. Your R-score, dollar winners over dollar losers, minimum 1.5, but you're targeting a long-term number of 2. If you can get over 2 long-term, it's outstanding, okay? An underlying portfolio volatility of 20 to 30% with low correlation. So we're trading options, and what we're actually doing is we're leveraging the underlying volatility of the portfolio. What does that mean? It means if you own the portfolio as long stocks and short stocks, what would be the volatility of your portfolio and what would be the correlation of the portfolio? And then you map onto that call options and put options to leverage that volatility. So if the underlying vol is 20 to 30% and you're targeting a Sharpe ratio, which is your return over your risk, you should be landing between 50 to 100% if your Sharpe ratio is 3. Okay. So that's what we're targeting all the time. And then generally speaking, your average days in a trade is going to work out. Your mean number with some acceptable variation is going to be somewhere between 20 and 25. So let's have a look at Adam, the guy who started with the most money and made the most dollars on his program. You can see his numbers at the top here. We looked at these before. So he did 64 trades in total. He booked $194,000 on his winners, $81,000 on his losers. He makes a gross 113. He's got trading costs of $1,500. He comes out making 111 after starting with 300 grand. So his portfolio goes up to 411. Okay. Oh yeah, just a side note. We trade a lot, mostly through a broker in the US called TradeStation, stock and stock options broker mainly, but we trade exclusively stock options, calls and puts. Okay. And you can see with his win rate, 83. So he's got 53 wins, 11 losses, 64 trades in total. Okay. And we can see here when we look at all of his trades, he's not really doing anything massively special. Right? Look at his numbers here. If we look, so I've sorted this by exit date. Okay. And I've screenshot this till the end of July. And there's a reason why I've done this here, because I wanted to show you up until mid-July, because he made most of his money in August. Okay. But you can see here up to this point, he's not really doing anything special apart from this one trade here, which is DR Horton DHI. Okay. And the point here is that what he's actually doing is in the first 3 months. So we've got May, June, July. Okay. In the first 3 months, he's just plodding along and making a little bit of money from his account, right? What he's doing here is he's booking a small amount of money every month. But what's happening is he's not having any blowout successful trades. Okay. He's just having small winners, some losers, but overall he's booking a positive number every month. So what does that look like? Well, it kind of looks like this, right? So if we go back here and we look at the trade count up to trade 36. So let's take a halfway point, 16, 17, 36 here. Okay. And then we look here. So he's up at the midpoint here around 40 grand. And he's not really doing anything special. So in May, he's made 20 grand. In June, he's made 14 grand. In July, he's made 10. But in August, he has a 68 grand month. Okay. So he makes his total money, his total percent, 37. Okay. What he's actually doing every month is booking what we call maintenance months. So he's got a 300 grand account and he's booking 20 grand in the first month. That's great, right? Book a 6% return. In the second month, he's booking just under 5. In the next month, he's booking just under 4. These are what we call maintenance months, where basically you're booking a bunch of winners, a bunch of losers, and some credits. Credits are when you're short options and you buy them back, usually at or close to zero, right? And all of that combined makes a positive dollar number. So what he's actually doing is he's learning how to manage his business. And what you're looking at here is what we call an equity curve, okay? An equity curve is just the equity value of your account. So what's your job as a trader? It's to make that go up. You don't sit there every month hoping it goes up. You make it go up. That is our job, okay? So it's very different to investing, where you sit for 3-5 years with a position. It's a mark-to-market position, and you just sit there and wait. And then at some point you might sell it. And the position the whole time is mark-to-market. It's not real, okay? This is real every month. We are realizing profit every single month to make the equity curve go up, okay? This is Porrick, the guy who made the highest percentage. So he started with 100 grand. With this guy, I got my last update from him. He sent me an update on October the 4th and said, boss, look, check this out. I'm continuing to make money. He at that stage was up just under 112 grand gross. Okay. Now what I've done here is, after introducing you to the concept of what a maintenance month looks like, this is with Adam. This is what it looks like if you just tot up the numbers. Okay. So Porrick, May, he's got a 100 grand account. He makes $19,000, which is not a blowout month. It's not a maintenance month. It's somewhere in between, right? So it's not like he's booking 5, 6, 7% in his account trading options, where he's booking some winners, some losers, some credits, make the equity curve go up in a small amount. He obviously had a decent month here, right? So he has a decent month because of this trade here, 15 grand. So that's in Next Tracker, NXT, okay? So if you see that one, he's basically bought an option, call option at 428, sold it at 1260, okay? So he's getting the right fundamental direction, making some money, buying a call option, trading out, booking it, having a good month, okay? Does he go back in? He can if he wants, right? The point is that you make the equity curve go up, okay? Next month, June, he has what we would call a maintenance month. Bear in mind now, his account is not 100 at this stage. Going into June, his account is now 119, okay? So his equity is 119. So he makes just under 11 grand. He doesn't have any outstanding trades. In fact, he has a trade here where he's down 10 grand on App Loving, okay? Which, by the way, at the time was a mistake. He basically bought too much of it. So he broke his limit by accident. And I actually shouted at him a little bit, said, you can't do that. He was supposed to be under $7,500. So he actually had to manage this loss here that month, but he came out of the month up 10,800. That's what we call a maintenance month. You book some winners, book some losers, book some credits. The equity curve goes up. Next, July. Bear in mind now, his account is 130 going into July. He only makes 7 grand in July, 6,900. August, he has a blowout. September, he has a blowout. Okay. So he makes big money on options. So he makes here, for example, on Bumble, he buys puts. So he buys 125 puts at 40 cents, sells them at 240 because the stock got buried on earnings. He makes a 500% return. So it's a $5,000 bet and he makes a $25,000 profit. He makes 193% return on buying Moderna puts mRNA. In September, you see these numbers here, 30 grand. He makes 30 grand in-app loving. So the one that he lost money on in June, he made a lot more on in September. So he got it right and got it right big. Okay. And then Make My Trip, which is basically, it's like the Indian version of booking.com. Okay. He made 15 grand there almost. So September, he had a huge month. So this basically got him up to 112 grand. The reason I'm showing you this is it all looks very straightforward, right? He's not really doing anything insane. What I mean by this is that if you look at these months here, June and July, he's just plodding along, keeping his equity curve going up, ticking over, making sure his business and his statistics are looked after. This is what we teach when we do a mentoring program. We teach you how to get the equity curve to go up and manage your business. Very, very important as a trader. Okay. So this is what his equity curve looks like. So May, as we saw, 19 grand, June, 10, July, 6,900, August, 32 almost, September, 43 grand. So he's come to ITPM, physically come over to Thailand to be taught by me and the other mentors in the classroom, gone home, and then we speak to him every weekend on a Sunday for a couple of hours, and we teach him how to do it and give him all the tasks to complete during the week. He comes back the next week, he's completed the tasks, he's making money. Okay. So this is how we do it. He's done that. And then in 20-ish weeks, I think 21, 22 weeks, he's at more than double his account, which is amazing. So you're probably thinking, I know this is more of an investment community. You're probably thinking, like, what makes a bad trader? Okay. Well, outside of ITPM, we get a lot of guys coming to ITPM who have got a lot of bad habits because of the things that they've done outside of ITPM. Retail traders generally engage in all of these bad behaviors or a big amount of them. Okay. Most amateur retail traders are wildly undercapitalized. Okay. You saw here, for example, with Porrick, how many positions do you think a guy like this has on at any one time? He's got about 10 positions on at any one time. Most retail traders are so undercapitalized, they don't have enough money in their account to allow for diversification. Okay. Additionally, their trade ideas are very, very narrowly focused. So they've either got one trade idea that they got told by somebody else, or they copy trade from media. Okay. So they're copy trading from either mainstream media like Bloomberg or CNBC or something like this, or online media sources like a Reddit, X, old Twitter, YouTube, whatever. And their focus is way too much on technical analysis and price action. Okay. Not enough on fundamental analysis. There's always an insufficient understanding of macroeconomics. What's actually driving stock valuations from the macro picture. Okay. Too much association with making money by just being long. Okay. If the market rallies, I'm just long this stock or that stock or the market, and I'm just going to make money if the market goes up, right? So there's just way too much focus on market beta. YOLO trading, all in on one idea. HODL, hold on for dear life, hold on forever. It's a get rich quick mentality, a lottery mentality. Some would call it financial nihilism. Okay. So where they look at, what a guy like Porrick does and says, all that work I have to do just to make 100%. It's so much work, and I don't have the patience, and I don't have the work ethic to do it. So I'm just going to buy some meme stock or a meme coin and hope for the best. right? We know how that works out. Yeah. Trading the P&L. So not focusing on trading the stocks themselves, but trading the P&L. When you're up big, you get more bullish. When you're down a lot, people always buy more, right? They're always trading the P&L. There's no exit strategies based on proper price targets, fundamentals, stuff like this. It's chaotic. Okay. They don't have preemptive risk management. What do I mean by that? It means that you put in some sort of rules, like diversification, for example, to stop you doing stupid things. Okay. So it's to hold yourself accountable to a set of principles, a set of rules that you just will not break. So, for example, this trade here, where Porrick booked negative 10,600 on AppLovin, he wasn't supposed to have a position that big. Okay. So he bought AppLovin was 18 contracts at 589 and they were worthless at expiry. But he was too big. He was supposed to have a single position limit of $7,500 and he broke it. Okay. Why did he break it? Bad habits. Okay. This is what retail traders do all the time. So that is a preemptive risk management rule. Single position limit. And there's many others, obviously, as well. Reactive risk management. Reactive risk management is when something happens in the world, something happens to your portfolio, all of your longs go up, your shorts go up, something happens, and there's volatility in your portfolio. Retail traders, their reactive risk management is always based on the P&L. Am I making money? Am I losing money? It depends. What I'm about to do depends on my P&L. Okay. And they always panic. So they buy all their shorts at the top. They sell all their longs at the bottom. It's always a mess, chaos. Time horizon, way too short. And then bad positions end up becoming bad investments. Okay. Very, very important one. Not treating trading and financial markets as serious, treating it as a hobby or some sort of entertaining venture, an entertainment adventure. It's just not. It's a risky business, and it's a money-making endeavor, right? So you have to be serious about it. Otherwise, you can lose a lot of money. So what actually makes a good trader? Well, for example, at ITPM, in terms of diversification, we have proper account values. The minimum to join ITPM after you do our online programs is $25,000. Okay. You have to put a minimum of 25,000 US dollars in your trading account, because to do it properly, you can't do it with any less. So if you're going to have 10 positions and you're going to have, say, $2,500 single position limits, okay, that dollar value just about allows you to do it properly in the US stock market, okay? Because you're going to be buying options, calls and puts, and you're going to be shorting options as well. You need the capital to be able to do it properly, okay? So, a lot of guys, retail guys, they'll put $200 in a Robinhood trading account, okay? That doesn't allow diversification, very obviously. $2,000 doesn't allow it, okay? At ITPM, our average account value is $60,000, and we've got over 1,500 traders. In terms of fundamentals, it's rigorous. The systematic process that we teach in our main video series, the PTM video series, it's called the Professional Trading Masterclass. It's 90% fundamentals and catalysts. It tells you which way the wind is blowing, and then your technical analysis and price action is only for timing the fundamental trade, okay? We have a complete understanding of macroeconomics and what is driving stock valuations at the time, okay? We've got diversified portfolios, and we're focused on alpha, not beta, and risk-adjusted returns, okay? We always focus on layering our processes to put the odds more and more in our favor, to get consistency in returns. We just don't play the lottery. We always want the odds in our favor, okay? And we're trading probable risk versus probable return. So we're trying to optimize with options our ROI, our return on investment all the time, okay? We always have preemptive risk management baked into our process at the point of portfolio construction. And our risk management in a reactive sense, when something happens in the world, when our portfolio moves, it's all based on us preempting it. So we always run through scenario analysis and we always plan out every move that we're going to make if something happens. Okay. This is really fast tracked through the ITPM mentoring program. So this is something Dieter learned in a lot of detail. As I've mentioned already, our time horizon is 20 to 60 days. We're not short-term focused at all. Your mean trading average in terms of the amount of days you will be in a trade with us is 20 to 25 days, as I've outlined earlier. And we approach our trading endeavor as a business. We take it very seriously. Okay, it's a business. So we have our process first, our performance second, and consistent business statistics. Like I mentioned earlier, it's our job to get the equity curve to always go up. If somebody, said to me, Anton, describe the job as a trader in as shorter sentence as you can, I just say to get the equity curve to go up. Like that's literally the end result of everything you do. That is your job. Okay. Get the equity curve to go up. As an investor, you can't get it to go up in a meaningful way on a regular basis because you're not exiting positions. Okay. When you exit positions, it becomes realized P&L, right? Investors sit on positions for years and then they might sit on a position for 5 years and find out it didn't work. Okay. Traders are very different. We like to see things work quickly, and quickly in our world is 20 to 60 days. And we're booking money every month. Okay. We're like a cash register, a cash machine that just generates returns every month. That's our job, to get the equity curve to go up every month. Okay. So guys, that's my 10 cents. I'll be back very soon for the Q&A, but Dieter's going to take over here.
Yeah, thank you, Anton. That was really, really powerful stuff. Really enjoyed that. I'm gonna go back now to sharing the screen. All right. Normally, you guys should see my PowerPoint right now. And so, yeah, I'm going to briefly talk a bit about my mentoring experience and what I did during my mentoring with Anton. So, as you can see here at the top, my statistics, I had during 2023, if we to the end of 2023 combined with it, around 70 winners, 40 losses. Win percentage 63% and loss percentage 36%. I think that's right on the average that Anton talked about with the average of his students right now. So that's actually a quite average performance. But the total return was good on the realized P&L. Total wins almost 300,000 booked, losses 191,000. And yeah, all I can say is watch the Dieter the Doubler video on YouTube. We go way more in depth, not to waste too much time on this spreadsheet information. So here's the summary. Starting capital 123,000. And then here you see the returns by month and the equity curve as well. So as you can see, steadily but slowly, trying to book always more and more realized profits. That's something I also say to you guys in the community, right? Try to book realized profits. Once it's realized, your equity curve is actually going up. You can compensate other losses, other losses of trades that you do or investments that you do. But when in the background, you're constantly booking profits, the equity curves keeps going up. And that's actually the name of the game, as Anton told us so nicely. So yeah, these are the returns here per month. You see there's sometimes a maintenance month where you have to take a break. And then there's months where you can book a lot of realized profits, and in the maintenance months, you're just trying to stay profitable, not take too big of a hit, and find new ideas, find new positions, and then give yourself again more time for your ideas, your fundamental ideas to play out. That's also what we say at Beleggers University, right? We look at the fundamentals, and then we try to look at stocks or sometimes a trade. But as Anton said, it's really important that you are really well capitalized. And we see too many people as well using trade ideas and then just putting on one trade. And we want to get you out of that mindset to really build a portfolio or do multiple trades. So don't only buy call options and then when the market takes a dive, you lose all your money. No, also make sure you have a good short idea or a good hedge somewhere to balance it out a bit. Okay. So now, what are the crossover skill sets that I learned from trading and that I brought over to investing? Because I'm also still investing in stocks, but I'm also trading on the side. So you become basically better at identifying good long and short ideas. I think you've noticed this at Beleggers University, or people who follow me for a long time. In the past, I was really value focused, but these ideas could take a long time to play out. And then in recent years, you've seen me taking more of like a little bit more of an aggressive approach. Because why? Because of what I learned from ITPM with Anton. So you find just way better long and short ideas. You become better at timing your entry as well, because if you trade within the 20 to 60 day time period, you actually realize that that's enough time for a stock to do a massive move. So you don't need to, when you buy a value stock or you buy a turnaround story, if your timing is wrong, like we have experienced now with multiple stocks already in our selection list as well, it's not going to help your performance. It's not going to help your profits, right? So knowing when to put on a position in trading or in investing, it's both very similar and very valuable. And also, you always have to ask yourself, why now? Why am I investing in this now at this moment? When the timing is not right, there is no point in going in right now. If you have no wind supporting you, you have no macroeconomic data supporting you, or you have no price action that points to a stock going up, there's no point in opening the position now. It's sometimes best to wait. Wait for a pullback or a breakout or whatever you're looking for. But that's really helpful as well. You also become better at exiting your investment, knowing when to get out. We had a community member asking us today, why did you sell Celsius perfectly at the top before it dropped 70%? Well, because of the trading process that I learned from Anton and ITPM, you start to have a feeling, also better feeling for like, okay, when is the best time to sell? When has your price target being reached? You become better at understanding the fundamentals, but also the way stocks move and the money flows of the big asset managers. What are they looking for when they're looking to invest? And it's going to help you time your investments way better. Using options to minimize risk for your long-term investments. Perfect example of this is in my book. I had a big position in Facebook, in Meta platforms, but the earnings were coming, interest rates were going up. I felt it could go down, so I bought put options on my long-term investment. What happened? The stock dropped a lot. This gave me a profit instead of a massive loss. So it proves that when you know how to use options smartly, you can minimize your risk or at least eliminate some risk from your long-term investments. Sometimes, I say this as well to our students, sometimes there's it's not a good idea to just buy a stock. Sometimes it's better to use options when it's a better use of your capital. Because options, you pay a fraction of the cost and you have leverage to the upside. Like, for example, right now we see that Zeta Global is having a scandal. There's a short report. Well, what you could do right now, instead of buying stock, is just like, okay, if you believe that the shorters are wrong, you can just buy a call option and then see what happens. But you only lose a small amount of money instead of losing a big chunk of your investment capital. You can use options to hedge your portfolio during nasty downturns or situations where uncertainty is very high in the market. Right now, it's a nice bull market. We're all flying higher, but once in a while, there's going to come a time where we're going to go down, and then you will be very happy to know how to hedge your portfolio. Okay, so basically, in general, understanding the trading game makes you understand the market better and makes you aware of the biggest participants in the market and the game that they play. That's very valuable as an investor. It helps you with market timing, when to exit, knowing about the macroeconomic data, knowing how the big players are positioning themselves. You no longer are a slave to the market. That's kind of my slogan as well. Once I learned all this stuff, you become more free and you're able to play your own game. Also, because you just use a spreadsheet to track your results, basically, a bad investment or a bad trade, you don't get emotional over it. It's just a line in a spreadsheet, and you know how to recover some money. You know how to trade out of it. You know how to look at different structures, give yourself more time, a new opportunity, and to just look at it as like a month-per-month basis. Try to book realized profits and make the equity curve go up. That's very useful. Anton is talking about investments. You buy a stock, hold it for 5 years. We are a little bit more aggressive sometimes. We buy a stock, sell it after 6 months, 1 year, or 2 years. Why? It's because also we can choose better stock positions and we don't get too attached emotionally to an investment. All right. So seeing your investments as a tool that makes you money rather than a romantic love affair with great companies that can never fail. That's really a big point for me as well, that I learned through this experience, is that every investment can turn ugly, even when it's a great company. And so are you going to be the one who's always going to be falling in love with a stock and then holding it while it's crashing 80% over a period of 10 years and then hoping for a turnaround? Or are you going to focus on actually making your realized profit and loss statement go up? I think that's a very big mindset shift, and that's a big problem in Europe, in Belgium, in the Netherlands. And I think that's why many retail investors don't book results. Okay, so some of our stock tips that we recommended at Beleggers University, well, they come basically directly from the ITPM trading process. Because why? If you apply the process of finding great trades, you basically find also sometimes great investments. And not every great trade is an investment, but sometimes a stock that could be a great trade is also a great investment for a little bit longer time frame, longer than 60 days. For example, Onon is a stock that we found because we look first at the sector, then we find the winner in the sector, and Onon was clearly the winner, so we recommended it, and then it went up 100% over the time frame of like a year. So that's longer than 20 to 60 days. But even in such a stock, for example, it's great for your trading portfolio as well, because you could, for example, here, when it's a good entry point, open a trade, calendar spread or call options, and say, okay, I believe the momentum is going to continue. And then in 60 days time, so a few months time, you can exit the position. So it's very similar process. Not every trade is an investment, but sometimes a good trade idea can become an investment for sure, for a little bit longer time frame. Tetra Tech as well also came onto my radar. Why? ITPM focuses on nice mid-cap, small-cap stocks mostly because they're more volatile, they have more growth potential. Tetra Tech was such a grower. Then it went up 40% in a year time, more or less. Applovin as well. You saw also that the other trader from ITPM that Anton recently coached had a trade in Applovin. Well, it's not that we talked about it beforehand, but Applovin was also a stock that we recommended, right? So you see that all these traders, all professionals, they look at the same winners in the stock market. So we also found Applovin a few months ago. I thought it was April of 2024. And since then, the stock went from 70 now to 286. So yeah, it's the same process. If you want to find winners, if you want to make money, you just have to follow a good process. And the good process, I learned it from ITPM. So yeah, this is my summary basically of my experience with Anton and ITPM. I'm very lucky that I found him at such a young age, in my opinion. Imagine if I only discovered him in 20 years. The opportunity cost is massive. We hear this all the time from people who join Beleggers University as well. Oh my God, I wish I discovered you guys earlier because I've been investing for 30, 40 years. And now I'm getting finally good information. So the opportunity cost of doing it later is massive, right? So you want to learn it as quickly as possible, and you want to learn it from someone good, someone reliable, and someone that is actually has experience in the sector. Don't waste your time watching free YouTube videos for the rest of your life, but actually follow an education and do it properly. So without Anton and the ITPM professional systematic trading strategy, I would not be where I am today, that's for sure. Anton is a world-class teacher. I think you've seen this now as well. The confidence he has and the way he approaches things is amazing. And he has experience from large institutions. You can't fake that. It's not some guy with a Lamborghini in Dubai telling you that you need to buy the next crypto coin. No, he's just giving you a systematic process how to do better as an investor and as a trader. So, as we discussed, learning how to trade properly will make you a sharper and better investor. Speaking 100% from my own experience, I came from the investing background, and I'm now more and more getting more and more passionate about the trading, because once you see what's possible, you basically can't go back to the boring value investing game. Okay. So Beleggers University is a great place to start. We are, I believe, one of the best. Why? We also did the effort, actually. We put in the work to learn from the best, and now we're trying to give some of that wisdom to you guys. But I would encourage everyone here on the call today as well to take it to the next level. If you feel like what you've seen today is interesting, and you have the money to do it, you have a nice big account, follow an extra education. Go to ITPM, see what they offer, contact Anton or his team directly, and see what's possible for you. We can only bring you so far, but clearly there's levels to the game, and what they teach is even the next level. Okay. So ITPM is the bridge between academia or theory and the real world. They really help you put it into practice. Otherwise, I would not have been able to learn it as well. And remember, nothing in life that is great comes easy. If you want returns like you've seen today, it's about working hard, putting in an education, and being consistent. Once you start to see it as a hobby, it fails. You have to see it as a business. You're managing a business that's going to make you money every month. And then you will be successful doing that process. All right. That was my little summary. Now I'm going to bring it back to Anton. So I'm going to put Anton back, and he's going to share his screen. Okay.
You can see me on the screen now, right? Okay. Okay, perfect. So I'll give you my short summary here, guys. So I've been doing this now for over 25 years, okay? And when I think, right back to where I came from, my childhood, the world hasn't really changed. There's still the haves and the have-nots. And the difference has never changed either. The have-nots are still complaining. They're still not seeking proper opportunities. They don't take risk. They're afraid to take risk. Whatever the reasons are, they just don't take risk. And therefore, they don't get the rewards, obviously. The haves seek out risk and seek out opportunities and reap the rewards. Obviously, trading and investing isn't everything, okay? There's millions of ways to make $1 million, okay? But if you do this properly, the rewards are really phenomenal. And the knowledge that you gain from learning how to trade properly compounds massively in other areas of your life, okay? But there are caveats to this, okay? So firstly, you can be an individual who likes to take risk, okay? But if you're a cowboy and you're looking for quick riches, you're one of these like YOLO traders suffering from financial nihilism, you're not going to succeed. You're playing the lottery, okay? That's not what the financial markets are about. So it's not just about, okay, I like to take risk, therefore I want to be a trader. Okay, there's many other elements about this, right? You need to take risk in a controlled way, okay? Second caveat, you can be somebody who's hardworking and passionate about financial markets. It's not enough, okay? We get this all the time. I'm really hardworking and I'm really passionate about financial markets. Don't care. The market doesn't care, okay? What the market cares about is if you're right, okay? So if you're focusing on all the wrong stuff and working really hard, you're going to get nowhere. Okay. You have to work smart. You have to know the right information and implement it properly. Okay. In today's social media world, Dieter's alluded to it a few times already. It's really difficult to find reliable and good trading mentors. There's so much misinformation, so much incompetence, and so much conflict of interest and bad actors. It never ends. Okay. If you manage to get through life and find people who can actually teach you and mentor you how to trade properly, it's a massive win. Okay. Most people won't. Most people are stupid enough that they won't actually find proper teachers and mentors in trading. They'll follow the entertainment of financial media. They'll follow the guys on YouTube who make an entertaining finance video and end up spending 5 years of their lives buried in nonsense and bullshit and come out the other side with nothing or negative. Okay. This is one of the main problems. This is why 99% of retail traders after 2 years have completely blown up their accounts. The bad actors do not solve the problem, guys. Okay. They literally are the problem. They are the problem. Okay. So what you have to do is you've got to acquire a professional level trading process, a systematic process. If you acquire a robust investment framework combined with a systematic trading framework and a consistent and repeatable process, okay, what's going to happen? You're going to get consistent results. Okay. It's consistent input equals consistent output. And it works in every type of market. Bull market, bear market, neutral market, doesn't matter. It works in every type of market across time. Okay. So you can literally do this forever in any type of market at any time you want. Okay. Obviously, every year the stock market looks different and there's different opportunities. What does a robust framework, a robust systematic framework bring you? The process essentially reveals the opportunities. It doesn't matter what market you're in. You apply the same framework in all markets and it reveals the opportunities. Okay. And you get to reap the rewards. So guys, if you want to attend our mentoring programs, we have a Thailand program coming up on April 17th next year. April 17th next year, starting in Phuket, Thailand. It's exactly the program that Dieter did. If you're interested in that, you can send us a message through the ITPM website. I'll give you the link in a second. Here's a picture of the team on Dieter's program. So you can see me and Dieter in the middle there. So this would have been in April 2022 or October 2022, I think. Yeah, October 22. October 2022. We also do remote mentoring programs as well. Okay. So you don't have to physically come to Thailand. You can do them with any of our mentors except me, just over Zoom. So you do 12 weeks over Zoom. You're speaking for a couple of hours every week. And then you're working for about 10 hours in between. So you can hold down a full-time job while doing this, while learning it. We're currently taking in new students for Q2 2025, meaning that you'll start in the first week of April. All of our online programs are included and you complete the online programs before you start live trading. So guys, that's it for today. Thank you for listening. I know it's gone on quite a bit. We did 90 minutes there. I'm happy to hang around for as long as it takes to answer your questions. So I'll stop sharing the screen and myself and Dieter can answer any questions you've got.